Hi everyone, this is Pete here. So today I want to share with you what I see in the market right now that is potentially the reason for the recent pullback. And I want to highlight to you as an investor what you can potentially look at to protect yourself. Let's dive straight into it. Now, a few weeks back, it all started with the US regional banks, right, having some troubles and, share price were dropping. And the two banks in question here are none other than Western Alliance and Zions Bank. And basically, they have exposure to an alleged fraud that is going to cost them millions of dollars. Now, this triggered one of the most famous phrase in the past month of financial market. And that is when you see one cockroach, there are probably more, right? By Jamie Dimon, the CEO of JP Morgan. Now, this gave many people a bit of worry about what the financial market is doing. Are we going to see another Silicon Valley, right? Or First Republic Bank where both banks ran into financial trouble? But to me, this is actually the preamble or so-called, the icing on the cake. The real issue here is much bigger than this. So what is the real issue here? Is actually what we call it as a repo market. Now, for those of you who don't understand the repo market, I'll give you a very quick run through on what this means first. So the repo market is actually a short name for what they call the repurchase agreement market. Okay, so this is a huge market that generates about $2 to $3 trillion a day. And what essentially repo market is a form of short-term borrowing, and very often just overnight, where the two parties agree to sell each other some securities with the promise to buy it back in the future. And that is usually the very next day. Now, to give you an example to illustrate how this works, alright, I have an example over here. So let's say Financial Institute A, okay, or we call it FIA, wants to borrow some money. However, it is running out of cash, but what it has is $100 million worth of bonds in its holding. But Financial Institute A is not willing to sell off these bonds because they still need it for other purposes. So what can it do? Basically, what it can do is to use these bonds and go to another institution, in this case, Financial Institute B, to say, hey, I'm going to let you hold on to my $100 million of bonds as a collateral. And in exchange, could you just lend me $100 million for just overnight? Okay. And Financial Institute B will ask, hey, sure, I can do that, but what is in it for me, right? So Financial Institute A says that if you do this for me, the next day what's going to happen is that I will buy back this $100 million worth in bonds, and I will also return you your $100 million plus a bit of interest rate on top of that, right? And we often call these the repo rates. Who is this market for? Essentially, this market is for everybody. Anyone can use it so long you need the money and you have the relationship with the various lenders. But generally, these are the people who need it, right? Whereby they need urgent cash and they don't want to sell off their assets. Okay, so this includes insurance companies, hedge funds, investment banks, and even corporate companies who may hold assets but they just need liquidity in the very short term. So what about a repo market that was scary is that it is not just now that we are observing something happening, but a similar situation happened back in 2019. Now you can look at this chart over here. This shows you what they call the SOFR rate, which is essentially the borrowing rate for the repo market overnight. And generally it's quite peaceful, around 1+% to 2%. But you can see there is a moment in time in September whereby this spiked up all the way to over 5%. Now, why did the rate go up so much back in 2019? There are many factors, but these are the main reasons. Number one is that at one point in time, many parties needed cash, right? And a lot of banks which were having cash, right, they will basically stockpiling all this cash and they doesn't really want to lend out because they feel that the situation was very risky and they are in a de-risking shift. So rather than earning that very little repo rate, which is like 2% per annum. So if you take it for one day, just 0.00 something, they would rather hold on to the cash. So in short, there was a shortage of cash in the financial system in 2019. And therefore, when the demand outstrips the supply, there goes the interest rate. So when the interest rate go up, what exactly happened in 2019 is that the borrowing rate went up to 5.25% overnight, and some rates even went as high as 10% within the day itself. Basically, the market participant couldn't get any funding overnight despite pledging what we so-call as a safe asset, such as the US Treasuries. So in the end, what happened is that the Federal Reserve came in to intervene, right? And they lent up to $75 billion worth of overnight funding on the fateful day of 17 September. And this 75 billion eventually expanded the whole repo market and making sure that the rate stabilizes and resume what they call balance sheet growth, which is effectively ending what we also call as the quantitative tightening. And this is crucial because in 2019, it was the first time that the Federal Reserve has to intervene in such a manner since 2008, which was the global financial crisis. So if this happened in 2019, what just happened this year? So this year, on the same month as September, but in 2025, once again, we saw that the Federal Reserve was lending out money again to the repo market to the tune of $18.5 billion in a single day. Now, this is actually tapping on a facility that the Federal Reserve created after 2019's issue, right? And they call this the Standing Repo Facility. Basically, any bank that needs money, if they can't get it at a good rate, they can actually go to the Federal Reserve to borrow it. And this was the largest draw of money from the facility since its inception, since 2019. And you would think that, hey, maybe it's just a one-off thing, after that it will cool off like last time, but all the way to October 16, the SOFR rate, which is the lending rate, continues to remain high at 4.3%, meaning that there is a little bit of trouble here. And on 28 October, we saw that once again, the Standing Repo Facility was tapped again for another $7.7 billion. And at the same time, the SOFR rate went up slightly to 4.27%. While right now we are already in November and it seems that nothing has happened, many people thought that we have avoided the bullet. But actually, the Standing Repo Facility is still being tapped at this moment in time. So which banks are more at risk, which one are more resilient? You can see that the banks involved here are generally the regional banks, so that will be the area that I would avoid in case there are any cockroaches coming out, just like what Jamie Dimon is saying. But I believe banks that are really diversified into different sources of income could potentially be an opportunity here if their share price pulls back together on this bad news. Now, if you want to find out more about the sectors, you can actually use Moomoo tools over here where you can track the sector performance real time. All you need to do is to go to the markets tab over here, and under United States, you can see in the heat map there are various sectors, and you can find the exact sectors that I was mentioning just now, which is banks diversified. Now, under banks diversified, you can see this is the general chart which tells you the performance of the sector real time. You can also analyze the balance sheet trends and compare key ratios across bank. One way is to click on components, and you can see these are the various components that are within this particular sector, right? And if you go into one of them, for example, here, this is Bank of America, you can actually see the financials compared across different years and even valuations as well. You can also use Moomoo AI to ask questions, for example, about the company finances, or just help you to summarize everything in one simple glance. Now, if you wish to test your trading skills, you can try out Moomoo's paper trade and stand to win real prizes in the second Global Paper Trading Championship with Nasdaq. This is a fun and risk-free way to learn how to trade US stocks with no real money required. And you could potentially win a share of $200,000 in total rewards together with other successful traders. Top 3 global winners will take home each up to $10,000 and even get featured on the Nasdaq screen in the New York Times Square. And the best part, it is completely free to join. Just use my link down below to register for the competition. And if you're already a Moomoo user, you will unlock 1 month of access to the Nasdaq Total View market data and also 1 month of Oprah options code. Now, if you're new and yet to sign up for Moomoo, in addition, you'll be able to enjoy an exclusive 60 Sing dollars Nvidia shares if you sign up through my link right now, and get an additional $5 trading cash coupon if you join the paper trading competition. So the latest one was actually on 31st October, where a massive $29.4 billion was pumped into the system because people were just running out of cash and they were tapping the Standing Repo Facility. But if you think that it is only 29.4, you will be very, very wrong, because that is only the treasury market. If you take a look over here, it is not just the treasury market, but even issuing another $20 billion worth of mortgage-backed securities. So all in all, if you add both together, it is close to $50 billion worth of liquidity being injected into the system. With that, it does look like the situation is very scary, but I just want to let everyone know that it doesn't seem to be 2008 all over again. For example, for Zion and Western Alliance Bank, they actually said that yes, it is about 270 million worth of debt, but right now, the CEO of Western Alliance came out to say that this is probably an isolated issue, so it's unlikely to repeat again, and he believes that the bank is able to tide through this. Another reason is that back in 2008, we can see that going into the crisis, there was a huge number of defaults on all these high-yield bonds. However, right now, when we look at the number of defaults for high-yield bonds, it is relatively low. In fact, it is falling rather than rising. And this year, the FDIC, which is supposed to insure all the depositors in the US, also did a review on the recent large banks' failure, and they basically put in more measures to strengthen the system. And one such proposal made this year was to make sure that banks over $100 billion in assets are subjected to stricter rules, including capital and liquidity stress tests. This is to ensure that such banks are able to survive and not run into a bank run once again, like what happened to Silicon Valley Bank. So overall, how should investors position yourself? I would say one thing is that if you're putting your cash into any US FDIC insured facilities, make sure that maybe you keep it within the limits, and maybe you want to spread out across multiple institutions. And number two, something that I'm doing myself is to actually spread out some of these funds outside of the institution by going into the money market funds. Now, for investors seeking opportunities, what you can potentially look at is to go into the banking sector to look for any banks that is currently selling at a cheap right now. There could be potential opportunities over there. So for instance, you can use tools like Moomoo to help you to follow the sector sentiment, track institutional flows, and even study technical signals to identify any potential entry points during such periods. So the key message here is that it is unlikely this is going to be another 2008. However, this is a reminder that the financial system is always evolving and there are some signs of stress right now. So being alert is going to be your best defense. Now, once again, if you want to track the bank's performance, how the interest rate move, or any opportunities that's created by short-term volatility, download Moomoo using the link below. It is free to sign up and you will get access to the same professional grade tools I use to analyze the market. Plus, you will get up to 1,315 Sing dollars of new user rewards right now, which includes 60 Sing dollars worth of Nvidia shares exclusively on my channel. And the link is down in the description box. Alright, that's all from me. This is Pete over here. I hope you like the content here. Let me know, how do you feel about the market right now? Are you feeling bullish or are you feeling bearish already? Right? And I'll see you in the next one. Bye bye.